Good afternoon. Good afternoon and welcome to the final lecture of the 2012 Food for Thought Luncheon Lecture Series. I'm Mary Kay Cooper, Director of Alumni Relations. This series is sponsored by the San Antonio Alumni Chapter and coordinated by the Alumni Office. The series is designed to spotlight Trinity's outstanding faculty. Before we get to today's talk, though, I would like to tell you about an upcoming event. On Tuesday, May 8th, Trinity's Ensemble in Residence, the Solely Chamber Ensemble, will present its final concert entitled Freedom. The concert will take place at 7:30 p.m. in the Ruth Taylor Recital Hall. Make the most of your evening and join Solely for a pre-concert talk at 7 p.m. Tickets are available at the door for $20. I'm pleased to have several special Trinity people with us here today, and I want you to be able to recognize a few of them. They are Trinity University President Dennis A. Alberg, Vice President for Faculty and Student Affairs, Michael Fisher, and Interim Vice President for University Advancement, Rick Roberts. I want to remind everyone that this program is being recorded so that people, I didn't touch anything, so that people all over the world can view or listen to it later. So during the question and answer period, please come to the microphone to ask your question. Thank you. Our speaker will be introduced by Ivan Finney, class of 1972. Ivan is a director on the San Antonio Alumni Chapter Board and a financial advisor with Wells Fargo. Ivan.
Good afternoon. Hopefully you're enjoying your meal. I enjoyed mine. Y'all are in for a treat. I've been talking to David while we sat over there, and he really knows his business. David Macpherson is the E.M. Stevens Professor of Economics here at Trinity University. Prior to joining Trinity University, he held the Rod and Hope Brim Eminent Scholar Chair in Economics and was director of the Pepper Institute on Aging and Public Policy at Florida State University. Earlier, he served as an assistant and associate professor of economics at Miami University. His teaching areas include principles of microeconomics, money and banking, econometrics, and labor economics. He received 2 university-wide teaching awards at FSU. Professor Macpherson received undergraduate and doctoral degrees in economics from the Pennsylvania State University. Professor Macpherson is an applied economist whose research focuses on real estate, pensions, discrimination, industry deregulation, labor unions, and the minimum wage. Dr. Macpherson has published over 50 articles in leading economics and real estate journals, including Review of Economics and Statistics, Industrial and Labor Relations Review, Journal of Labor Economics, Journal of Human Resources, and Journal of Real Estate Economics and Finance. He is co-author of the undergraduate labor economics text, Contemporary Labor Economics, as well as the Principles of Economics text, Economics, Private and Public Choice. He's also co-author of the annual Union Membership and Earnings Data Book, Compilations from the Current Population Survey. He is included in Who's Who in Economics 4th edition, which includes the 1,200 most frequently cited economists in the years 1990 through 2000, using the Social Science Citation Index. So if you'll join me in welcoming Dr. Macpherson.
Well, thanks very much for having me. Today I'm going to talk about trends in pensions, which is one of my major research areas. And I want to first give you a little overview of what I'm going to talk about. First, I'm going to talk a bit about the trends in pension coverage overall, as well as for different types of individuals. Then give you a brief introduction as to what the different pension plan types that are existing, why the decline in pension coverage has occurred in defined benefit plans, then talk about the costs as well as benefits of having workers control how they invest their pension assets, and the factors that have caused this rise in participant direction that's occurred over the last 2 decades. And lastly, talk about what impact has participant directed had on terms of the rates of return that people get, how they invest their money. So let's first talk a little bit about the overall trends in pension coverage. I plotted out some data that I got from 1979 to 2010 from what's called the Current Population Survey. It's a large survey of individuals in the US each month. And what the blue line shows you is whether a firm offers a pension. And you can see that back in 1979, about 55% of people worked at a firm that offered a pension. And if you look in about 2010, still about 55% are offered a pension at the firm. But not everybody participates in a pension plan at the firm. And that's what the red line is getting at. And that's the percentage of people actually covered by a pension plan. And you can see it's a little bit less than 50% in 1979. And in 2010, it's a little bit lower in the low 50s. So there's been a slight drop. And you might ask, well, why if a firm offers a pension, not everybody's in it? Well, there's a couple of reasons. One is that the firms can exclude some people. Say, for example, if you're under the age of 21 or if you've been at the firm for less than a year. But the gap, you can't quite see it there vividly, but the gap has widened a bit over time between the firm being offered a pension and those in. And now people have the option to opt out of a pension that didn't really exist in 1979. And we'll talk a little bit more about that later. But even though the overall pension coverage hasn't changed a lot over the last 3 decades, different groups in there have in fact had big changes. So let's look at some subgroups of people. What I've plotted out here is the blue line has it for public pensions. So about 70% of all public sector workers have a pension. I don't know if you know that in the last year, there's been a lot of debate about public sector pensions being too generous relative to private sector. But you can see that there's been virtually no change in their pension coverage. So the drop that has occurred in pension coverage has occurred completely in the private sector. So it's dropped from a little bit over 40% to a bit under 40% by 2010. And here's one of the things that I think one of the most striking changes over the last 3 decades is what's happened to the male-female gap in pension coverage. You can see that in 1979 there was a large gap between men and women. There was about 55% of men who were covered by a pension, but a little bit less than 40% of women were covered. But as you can see what's happened by 2010, there's just over a 1 percentage point difference between men and women now in pension coverage. And it's driven by a couple of things. You can see that male pension coverage has been dropping and female pension coverage has been rising. And what's interesting about this is that the gap in pension coverage now is smaller than the gap in wages between men and women. So there's been a rapid closing of this gender gap in pension coverage. And the question, of course, is why? Why has it gotten closer? Well, one of the reasons why men's pension coverage has gone down is that the sectors of the economy that offered pensions were heavily male, were like unionized firms, manufacturing. Those sort of industries have declined in size in the economy, and therefore they have less pension coverage. Women, on the other hand, have been moving into higher paying jobs, and higher paying jobs are more likely to offer pensions. And so that, a couple of the reasons, and the labor market attachment amongst women. They're more likely to demand pensions because they're staying in the labor force longer. So that's one of the good things I think has happened over time is this gender gap has basically been eliminated between men and women. But one of the more troubling patterns that's occurred over time is what's happened to, if you look at the gap by education level. The blue line shows you what happens with those with 16 or more years of education. In other words, a college degree or more. And you can see that it's barely budged in terms of the pension coverage. It's right about 60% of all college graduates are employed in a job in which they participate in a pension. But if you look amongst the least educated, those people with less than a high school degree, it's dropped from a little bit less than 40% now to less than 20% and about 15% or so. So it's been a rapid decline in the pension coverage amongst these high school dropouts. Now, again, one of the things that's really driving that is industry shifts, right? Away from unionized plants, manufacturing, the firms that tended to offer pensions to less educated workers. But there's also another factor that we're going to talk a little bit more about later, about the 401k plan. And this is a typical type of pension plan where you can opt out of participating. And the least educated workers are the ones opting out to participate. So it's a combination of shifts away from sectors where they had high pension coverage for less educated workers, as well as opting out of it. Another pattern that has been less well known is what's happened in terms of the pension coverage gap by firm size. Well, you can see that larger firms are more likely to offer pensions. That's the blue line. That's firms with 1,000 or more workers. And bigger firms are more likely to offer pensions for a variety of reasons. There are economies of scale. That is, it's cheaper on a per worker basis to offer a pension plan at a larger firm than it is a smaller firm. The larger firms may want to have pensions more because of they want to encourage workers not to quit relative to small firms. But you can see that at small firms that pension coverage actually has been rising from 10% of the workforce in 1987 to 20% by 2010. So small firms are actually offering pensions now, and workers are participating in them at a much higher rate than what occurred 20 years ago. And I've looked at this issue and I've looked at so why this is happening. And one of the reasons why it's happening is that they're getting more educated workers at small firms relative to what they had in the past. And more educated workers are more likely to want to have a pension. And other factors have been technology changes, such that, for example, the personal computer you can use at a small firm, right? But 20 years ago, you had a lot more use of mainframe computers. So technology has been able to be adapted to smaller firms that has changed relative to the past. So they want to have more pensions. Well, let's talk a little bit about this pension type. So I alluded to the idea of this 401k, which we'll talk a little bit more later. But the two major types of pension plans. One is the defined benefit plan, and there the pension benefits determined by a fixed formula. So what happens is that you take we call a generosity rate, or what I call letter B here, and that is like a number ranging between typically 1% and 2%. And public sector workers, by the way, have much closer to generally 2%, while private sector workers have rates of about 1% on average. So let's say we're talking about a private sector worker. You'd get 1% for every year of service that you work. So in other words, after 30 years, you get 30% times your final salary. So if you made $100,000 at your final salary, you'd get 30% of that, or $30,000 a year. Now it'd be paid as an annuity. So you'd get that $30,000 each and every year until you die. Okay. Now, these defined benefit plans were the main type of plan that existed back about 30 years ago. They were the majority of the plans. And it has particular characteristics. And one is that the employer invests the funds to pay the benefits. So in other words, they put up a pension fund, they put money each and every year, and they take the chance of the fact that if the returns are low, they're going to have to kick in more money to make that promised benefit. Now, another feature of these defined benefit plans, why firms might want them, is they penalize workers if you leave early. So, for example, I had a defined benefit plan when I was at Miami University, and I left after 5 years. I was entitled to my pension. And I worked out, being a pension economist, that it was worth, well, about $4,000 pension for me, 15 more years in the future. So in other words, you discount that today, it's very little money. So the best thing for me to do is simply take the money and leave, right? They really penalize you if you quit the firm early, right? And why the firm might want to do that is that they may want to actually discourage people from quitting. Say the firm has invested a lot in you. It trained you, put a lot of skills into you. They don't want to lose those skills to a competitor. And so they want to design a pension to stop you from doing that. Okay? And so that's why that firms that offer training to their workers are more likely to offer pensions, particularly this type of pension. But the other type of pension that exists that's a lot more popular in recent times is the defined contribution plan. And there what happens is the contributions are paid into an account for each worker, and the contributions can be made either by the employer or the employee or both. And this is an important issue that we're going to talk a little bit later. Either the firm can decide how that money is invested or the worker. And what's happened in these kind of plans is that the benefits are determined by how much is in your account when you retire. And so what happens is that the worker absorbs the risk if the returns are low. So in other words, in the 2009 decline in the stock market, say you had all your money invested in the stock market, it fell by 50% between 2007 and 2009. Well, one of the things that you're going to absorb the fact that you're going to get, in essence, half the pension benefit you were going to get previously if you're in defined contribution plan. So you definitely take more risk. But on the other hand, you get a benefit out of it as well. That is, the worker is much more mobile so that you can quit the firm and you're entitled to all the money that's in the account. And so that there is no penalty for quitting, basically. So let's look at a graph of what's happened in terms of the active number of participants in pension plans over time. Well, the black line shows you what's the total number of pension participants. And remember those numbers before I was doing as a share of the economy? This is actually the raw number of people in the pension plan. And you see that little break there in about 2005. And that's when the government did a little change in how they measured what pension plans. That's why you had that break. But you can see the overall pattern. The blue line shows the number of participants in the traditional or defined benefit pension plan has been steadily falling since the mid-1980s. But on the other hand, what's happened is that the red line, which is the defined contribution plan, has shown a rapid rise in the number of participants over time. Now, one of the things we want to talk a little bit about is the 401k plan, because that's a particular type of defined contribution plan. Traditionally, defined contribution plans, what happened was, when you go back to 1979, is that when contributions were made into the pension plan, they were made by the employer, and the worker couldn't voluntarily decide, oh, I want to contribute more towards my retirement plan. That's the particular feature of the 401k plan, is that workers can make pre-tax voluntary contributions to the plan. And they've gotten a lot increase in popularity because one of the nice features if you're an employer is that you can gear compensation to the workers you value the most. For example, if you contribute to a pension plan, that tells the employer something about you, right? It tells you you're more of a saver. And so what happens is a lot of these 401k plans have a matching feature. That is if I contribute 5%, then the employer contributes 5% for a total of 10. But think of the signal that you give the employer by saying I'm contributing 5. It says, again, I value the future more. And so if you value the future more, you're going to have characteristics that the employer probably likes. Okay? And one of those characteristics you might like is you might not want people quitting on you. And so what I did, one of the things, research projects I've looked at is I've looked at what happens to people who contribute to 401k plans. Are they in fact less likely to quit in the future? And the answer is yes. So that those people who opt out of the pension plan are the ones more likely to quit. And other people have found they're more likely to be absent from work. So what happens is that you can really lower your pension costs and gear your compensation out through the 401k plan. And not only that, the 401k plan has the advantage for the employer, they're cheaper to operate than a traditional pension plan. So I think there's a lot of reasons why they've become a lot more popular. So let's talk about why is it that the defined benefit plan has become less popular over time. Well, there's three basic things that have been going on. One is there's been a change in worker demand. Workers basically want to be more mobile. And as the labor force has become more female, about half of the labor force now is female, they traditionally have had more in and out of the labor market than men have. And so they're going to want a pension plan that doesn't penalize them if they quit early. And also there's been a switch away from unionized workers to less unionized workers. And union workers tend to have a higher demand for pensions. So part of it has to do with the fact that workers don't want them as much, but also there's been shifts away from industries that tend to traditionally had defined benefit pension plans, in particular manufacturing. But I think there's another non-trivial and important factor, and that's the fact that the cost of defined benefit plans have gone up in a variety of manners. One is there's been changes in the asset markets. And in particular, a couple of things I'm thinking about there. One is the fact that as interest rates have fallen, what's happened is the cost of firms have gone up because remember they've got to pay that annuity for every year you're alive. Well, if you have a lower interest rate, that increases the cost of the annuity. So the cost of the defined benefit plan has gone up because of that. And another factor is there's been the lowering of the cost of alternatives, like the mutual funds are a lot cheaper to offer than they were in the past. Those costs have come down. Another factor has been increased longevity. When they developed the projected cost to employers of these defined benefit pension plans, they base them on life tables. And the problem is that these life tables keep getting wrong. People have been living longer than they anticipated when they set up these plans. So the firms have to contribute more money into the plans because people keep living longer. So it's getting more costly for them. And also, there's another problem is a lot of regulations have been imposed on defined benefit plans that are costly. They have, in order to comply with Department of Labor regulations, they have to have a lot more paperwork that defined benefit plans have to do relative to defined contribution plans. They also have to have the problem of funding levels. What happens is that pension plans, defined benefit plans, cannot either be overfunded or underfunded. It's got to be like the Goldilocks level of funding. And so what happens is, let's say the firm does a good job saving for the pension plan. What happens is that they put too much money in the pension plan, the government taxes it, right? And so that if it's too well funded and they can't retake the money back out. Another problem if it's underfunded, then the government goes after them for that. Right? So, and they also have to have, and so let's say they are underfunded. Well, one of the reasons why they can be underfunded, let's say the returns are very low because the stock market falls in a given year. And so the funding levels go down. That means that they have to really ramp up their contributions to remain in the appropriate funding range. Well, the problem with that is, remember, if they overfund, they can't keep it. It gets messy for them. The costs are clearly high under a defined benefit pension plan. If they have a defined contribution plan, all they got to do is say, we're going to give you 10% of your salary, it goes to the fund, and they'll be done with it. Okay. So one thing to look at here is I've done a graph here of defined contribution participants as a percent of all pension participants. And you can see what's happened is over time it's more than doubled since 1975. So now we're up to about 70% of all pension participants are those who have a defined contribution plan. And it's a little misleading here on this graph. And why it's a little misleading is that a lot of defined benefit plan participants also have a defined contribution plan. So there's a little bit of double counting. If you restrict this to people who have only a defined contribution plan and not both, then it's a little bit less than 60%. So a little bit overstates. the fact that switched to defined contribution plans. And here's the thing I want to talk about the rest of the time is, while a lot of my current research has been focusing in on, is participant direction. And what I've done here is showing you a graph of what's happened over time in terms of percentage of people who are in a defined contribution plan who have control, at least in part, over how their assets are invested. So if you look back in 1988, the first year we have data on it, a bit less than 20% of all pension, DC pensions, the worker had at least some control over the assets. But by 2006, it was up over 90%. So there's been a dramatic shift over the course of let's make sure, 20 years, right? 20 years. 20 years of time. I mean, that's a dramatic change. And the questions are, there's a lot of questions like, well, why has this happened? What happens when you give workers control of their assets? And so that's the things we want to talk about next. And let's talk first about the pros and cons of having workers control the assets in the pension plan. Well, one potential problem is that the administrative costs could increase because you have to have an account for each and every person, and how that money is invested is going to differ. And here's the problem that's particularly popped up in the early part of that time period, is the employer could be liable for bad choices. So let's say you're a worker and you put all your money in Enron, right? You lose it all. It can happen. Can you go sue the employer? Well, it depends on, there's some rules that the employer has to meet to avoid that lawsuit. Okay. One other problem is that the employees might reduce their share in employer stock. And you might not think that's a big issue, but it really is. You may not realize that about 20% of all defined contribution pension assets are invested in employer stock. Now the question is, why do they do that? Well, employers wanted to align the incentives of the workers with the firm. That is that when the firm does well, the worker does well. So it encourages the firm to do well. They want to have the worker have the incentive to increase the stock price. Well, if the worker has a choice to opt out of employer stock, they might in fact do that. Another problem that's been raised is the fact that employees may not be financially sophisticated. One of the problems we've observed is that when employers offer employer stock to the workers, they'll have often a matching feature. That is, if you contribute by 10% of your pension in employer stock, we'll match it another 10%, something like that. Well, what happens is that the rational strategy should be you stop when the match stops. But the problem is that workers think, well, the employer is offering me this good deal here. It must be a really good company. I should go invest even more. When the financially rational strategy is diversify away. Okay. Another problem is, and I suffered from this when I was in graduate school, is the one over N strategy. And that is that if the employer offers you 4 choices, you put 1/4 in each of those choices. Well, when I was in graduate school, I had TIA and CREF, the 2 big pensions. Well, I don't know what percentage, let me put half in each. And that turned out to be the wrong strategy. The stocks did way better. They got the failure to rebalance. That is that people have a lot of inertia in terms of how they invest their pension assets. And so the one side gets out of whack. In other words, they have the stock market has done very well. They don't reduce their share in the stock market to make it more balanced. They keep it whatever it is. And there's some evidence people have overreaction to recent stock market performance. And what I mean by that is that when the stock market is doing well, people start investing even more in the stock market, right? Or when the market's doing poorly, they start selling. But here there are some advantages. And one of the really important one is that it gets a better match between the employee's preferences and the pension asset allocation. Let's say that you are getting close to retirement. You may want to invest more conservatively. And so you can do that if you have participant direction. But if you don't, the employer has to do it on the basis of the entire workforce. And so they're going to take the average age's preferences. So you might get a mismatch between what would be best for you versus what would be best for the average worker. So let's talk about some reasons why, in fact, it did increase. Well, what happened was they passed some regulations, and it's called Section 404C, which protected employers from getting sued. So in other words, take Enron. If Enron meets these three criteria, then they cannot be sued for bad choices by the choice of the workers. First, they have to provide a broad range of investment alternatives. So you have to have some stocks, some bonds, some cash, a variety of different assets that the workers can choose from. And, this nice legalese, as appropriate, however that's defined, you can allow participants to change their investment allocation as frequently as appropriate given the volatility of the investments. So if you have assets that are very volatile, then they have to give more chances to get out of those assets. And you got to provide specific disclosures about these investments and sufficient investment information to participants. But if you meet all three of those, then you cannot be sued for bad choices done by the workers. Well, there's a couple other reasons. One is you got these technological advances in the sense of it's a lot cheaper now to administrative costs in managing these separate accounts, right? You've got fast computers, you got the internet, and clearly it's a lot easier to get daily trading and valuation, right? You can go TI-CREF, the major one for faculty, you can find out the value each and every day at 9 p.m. Not that I'd have to know that. And it's easier now to satisfy the 404C, right, as because of this technological advances. Now, and also the thing that's really changed over time has been the growth of mutual funds, which provide a low-cost way for diversifying, even for, again, very small amounts of money. And they have skyrocketed the value in mutual fund assets, from $1 trillion to over 10, and then it dropped, and now it's gone back up again. Now, one way to look at the importance of these factors is to look at the percentage of plans with 404C protection. And you can see that it's been rapidly increasing the Section 404C protection, so now over 3/4 of all plans are immune from lawsuits from the workers, and it keeps rising each year. Now, when I ask why you have more recent data, the problem turns out is they're very slow in releasing data from the Department of Labor. You have to wait years. Well, the things that I wanted to look at is to look at what happens now when you give workers choice of how to invest those assets. So one of the first things I started to look at was employee contributions and employer contributions. And if you give workers control over their assets, their contributions on average rise 7.6%. So if you control the asset, not the employer, that means you maybe can invest those assets the way you want to do it. You're more willing to contribute money rather than when the firm tells you. But it's interesting is that the employer contributions fall by 1.1%, but total contributions, in fact, rise by 6.5%. So by giving participant direction, people actually are saving more for retirement, which is a good thing. Now, in terms of asset allocation, what happens is that, well, the firms have a good reason to fear that workers will, in fact, shift out of employer stock if they're given the choice. And so the employer's stock share falls by 6.1 percentage points, which is a pretty big fall in terms of shares invested in the own employer stock. Now, what goes up is a share that's managed externally, and that is through like mutual funds. That's the major one. That goes up, obviously, when a participant direction takes place. Now, one of the things I wanted to look at a bit was not just how they invest the money, but how well they invest the money. And what I've plotted on this is the black line shows you the market index. And what I did was I got the index for the total stock market. And then I have a red line and a blue line. And the blue line shows trustee. And what that means is that the firm invests the money for you. Okay? And the blue line suggests is the participant direction. The worker invests the money. And you can see that there's a general pattern there that pops up a bit, particularly since the late 1990s, is that the returns tend to be higher and the stock market is doing well. right? If the participant manages it, they're also worse than the trustee managed when the market does poorly. To get a better feel on that, I split it into the 90th percentile and the 10th percentile. What the 90th percentile means is that the returns at this point are the 90th percentile. It means that 90% of the pension plans are below this level, 10% are above. Now the 10th percentile is where it's the opposite of that, the bottom 10. And you can see what happens here. Again, that at the 90th percentile, it looks like the trustees do a little bit better, right, in terms of their investing. They're consistently a bit higher. But you can see in the 2000 to 2002 decline in the stock market that the participants did not do very well. Okay? At the 10th percentile, it's a little bit better for the participants. So the extremes are different between the bottom and the top in terms of participants versus trustees. Well, the next thing I wanted to look at a bit is look at how well they did after you adjust for investment allocation, right? In other words, one of the reasons why those returns might be high or low is how they invested the money. And that's called an alpha. Now, beta measures how responsive that planned return is to changes in the stock market returns. So in other words, if it's zero correlation, that'd be like you had all the money invested in cash. Right? Now, if you have a beta of 1, that means is that you in essence have perfectly correlated with the stock market, that you'd have all the money in the stocks. So let's take a little bit of a look here of what alpha looks like. And again, this is after you control for how the assets are invested. And what I've done here is I've got the participant directed is the red boxes, and the trustee is the blue solid part. And it's really hard to tell here much, but you can see basically that there's a slight, ever so slight, to the right for participant directed. It's very slight. It's measured in what we call basis points. That's fractions of 1%. So it's a very, very small difference. So what basically that's saying is after you adjust for how the money is invested, participant direction doesn't do much relative to trustee. Now, the one area I'm working on now is looking at unionized plans and looking at how unionized plans do relative to when the union manages the money versus when the worker manages the money. And there is a big difference between the participant directed and the trustee. That is that when the union manages the money, particularly in what they call multi-employer plans, that is a plan that the union has across a variety of employers. Like, for example, the Teamsters Fund is particularly a bad one. What they do is they have the UPS, right? It belongs to the Teamsters Fund, but they also represent workers at other trucking firms, etc. Well, what happens is that they have very low alphas. They do poorly, and there could be a variety of reasons. They might try to do investing that matches what the union goals are. For example, one of the things I've been looking at how they invest in only unionized building construction plans, right? So in other words, the pension invests in construction projects that are made only with unionized labor. Well, unionized labor costs more, so you would expect maybe a lower rate of return. Well, what happens is that when you give the workers control over those assets, what happens is that it wipes out that negative union effect. And so that it offsets, so the unionized workers who have participant direction are no worse off than the non-union participant directed workers. But the unionized workers who don't have control of their money are worse off. Well, the other thing to look at a little bit here is, and this one's much more stark, is to look at the betas. In other words, again, how well correlated are these returns with the overall stock market? And you can see here a pretty stark difference, I think. That is, the blue again represents the trustee, and the red, the participant directed. Well, all those bars are shifted to the right for participant directed. That means that when workers get control over the money, they're taking more risk, is basically the bottom line. Their return, their beta is substantially higher than what it is for the trustee directed. So remember how we showed that in the downturns that trustees didn't do as badly as participant directed, but in good times, the participant directed did better? Well, it's because they were invested more, in essence, more heavily in the stock market. So that's what's going on with the participant directed part in terms of the beta. Let me give you a quick summary of what I've found is that, again, there's a small drop in pension coverage overall. There's, again, a much smaller drop, a much smaller gender gap in pension coverage. Again, it's down to 1%. Again, that is such a small difference relative to the gender gap in wages. There's been a large drop in pension coverage for the less educated workers. We've had a big rise in defined contribution coverage, but a fall in defined benefit. And clearly, participant direction has risen substantially over the last 2 decades. And what I wanted to do is point out again that Section 4OC played a role, but that's not the only factor. Remember, they had that technological advance, as well as the lower cost of providing mutual funds. And in terms of participant direction, clearly increases employee contributions, changes that asset management from having in-house management to third-party management, reduces that employer stock share. You get the higher beta, you get more correlated with the stock market. But, and this is the good side, it's been relatively little effect on risk-adjusted rate of return on pension performance. Now, one of the points I should point out that last one is that we're looking at all this analysis at the plan level, right? So we got the universe of pension plans in the US. But there can be variation within the pension plan, right? You could have some people who invest very poorly, right? So there's going to be more volatility within the plan than there's going to be across plans. And the problem is getting that kind of individual data is very hard to get. But did anybody have any questions at all? Go ahead, yeah.
Just from a public policy standpoint, talking about the portability issue, as
Yeah.
workers spend less time during their working career with any individual one firm, what changes need to be made to make it easier for individual workers to have seamless portability as they move from employer to employer?
I think there's pretty good portability right now. I think one of the problems people have is taking the money out of the pension plan when they switch employers. I mean, right now that if you left a pension plan, you can go invest that into an IRA if you want. You can roll it over into another new employer pension plan. It's there's not a big problem with portability of defined contribution plans. I think the problem is more people taking the money out of the pension plan, period. And the question is who takes the money out, and it tends to be the least educated people take the money out. And they're the people who probably need to save it the most because they have least other assets to retire on. Go ahead.
Did you look at corporations that have savings plans in addition to the pension plan?
You mean, I'm not sure, you mean to defined benefit pension plan or?
Yeah, I guess that would be a defined benefit, but
Yeah.
The company I work for, if you wanted to go into a savings plan, this was entirely separate from your pension. And the matching was done there. The pension plan was based entirely on your salary.
So is the saving plans tax-free or not? That's the,
Not your contribution.
okay, so it's an after-tax contribution. I haven't really looked at that as much. I mean, I've looked at the ones that would be tax-free, the pension plans, the 401k plans, but not the thrift savings. I haven't looked at those. I don't think they're as popular.
They're not left. They're not, you couldn't find one of those surviving.
Well, that'd make it a short paper.
My
Good.
question regards the public sector pensions.
Yeah.
Particularly, let's say the city of San Antonio.
Yeah.
Our firemen, our policemen,
Yeah.
they have pensions. Are those funds invested somehow for them, or is this just they're going to take taxpayer money when they eventually need to be paid?
Well, that's one of the big issues that's going on right now with public sector pension plans, is they are underfunded and underfunded a lot, depending upon what state or locality you're talking about. Some states are in good shape, like Florida actually is close to fully funded. Other states like Illinois are extremely far from funding. So it really depends on the locality of where you're at. But ultimately,
San Antonio.
I don't honestly know about San Antonio's funding level, but different. Ultimately, the taxpayer is going to have to make up the shortfall if there's a shortfall. But some states are well funded. Are there questions there? Go ahead. Yeah.
Yeah, I'm just curious, from an employee standpoint, do your figures actually represent how much money the corporations are actually putting into the pension? Because from what I've seen, number one, 401ks for the average worker is never going to be as good as a pension when they retire. There's no way a 401k can amass enough money for someone to live on that for the next 30 years unless they're a very highly paid employee. My impression was that companies are going to 401ks because they're not having to pay as much to employees.
Oh, absolutely. I think cost is an important factor. That in fact it is cheap. Well, it's cheaper to operate a defined contribution plan, putting aside in terms of compliance costs, et cetera. You have to worry about longevity if you have a defined benefit plan. You don't have to worry about that with a defined contribution plan. They're shifting the risk from the employer to the employee. I mean, I agree with you. I doubt that well, it depends on stock market returns as well as asset returns, right? Other assets. It's going to be more difficult relative to the traditional defined benefit plan. And I think because they were so costly, that's why there's been a shift. I agree with you. And also the workers want to kind of switch in the sense they don't want to be tied so much to an employer, right? Other questions there? Go ahead, yeah.
The Texas Retired Teachers Association is very concerned about this issue.
Mm.
There's a big conflict between the people, the outside people who want to change our pension plan to defined contribution. We like the defined benefit. What can we do to keep it?
What happens is lobby. That's what basically happens. I mean, and you got to think about the other side though too. Think about from the workers' point. I used to be in the Florida plan, and only about 20% of the people were in fact going to make it to 30 years, right? 70% didn't even make it to 10, and so that. Or I only made 5 years in the Ohio system, and you get really penalized a lot if you quit early. So if you do in fact make it, you are clearly better off under a defined benefit plan, if you take the typical plan. Problem is, say you're not one of those people, then you've got a problem, right? Because 70% don't make it 10 years. I can tell you the present value of the value of the pension is greater under a 401k than it would under a defined benefit plan if you lasted 5 or 10 years. Now, if you go the other end of the extreme, last 30, the defined benefit plan will be better than the 401k. So the question is that what kind of person are you going to be? Are you going to for sure stay with this employer or not? And when I signed up, when I moved from Miami University to Florida State, I was starting really my pension research then. I talked to the pension person. When you had 90 days to make a decision of whether you wanted the defined benefit plan or the defined contribution plan. And I asked we had 60 faculty hired that year, so it's a big group. And I asked her how many people chose the defined benefit plan over the defined contribution plan. And she said 1. And it wasn't me. Because we weren't sure we were going to stay, right? And a lot of workers aren't going to sure they're going to stay with the employer. And that's the problem. I agree with you, you're better off if you know you're going to stay, but you're going to be worse off if you don't. And if you don't know in advance, you're better off not taking.
Where does our money go?
Oh, where would your money go? Well, the money has to get set aside. I mean, they can't break the promise of the pension. Believe me, if they have a defined benefit plan, they have to fund those benefits. It's well established in law that if they're promised to do that, they can't take it away. In fact, there's a lawsuit going on in Florida right now that what they did was they tried to avoid a lawsuit, because what they said is we want to switch all new people to a defined contribution plan, and we want to change the pension rate of accrual. So what, in other words, is that if, say, you work 20 years in the Florida system, what they wanted to do was, starting on your 21st year, this in 2011, they said, we're going to reduce the cost of living adjustment. And the question is that a violation of an implicit contract between when you got hired and the between the employer and you, or is it not? Now, a district judge has ruled on that case, and what they've ruled is, she said that it is a breaking of the promise. So the thing is, it's really hard. Now, it's going to go to the Court of Appeals, because we're talking billions of dollars here. The Supreme Court in Florida is going to eventually rule on whether it's a breaking. They clearly can't reduce your benefits in the past. There's no debate about that. The question is, can you change the pension benefit formula for people who are currently employed for future service? That's the question. And most states have been ruling in favor of the workers. So I don't think you have to worry. Other question? Okay.
Well, I mean, I really like that, but then I'm a financial advisor. So, this lecture concludes the 2012 Food for Thought lecture series. And help us plan another successful series. We will mail you or email you a quick survey so that you can submit your comments and suggestions for the next series. Thank you for your interest in the series, and we look forward to seeing you again.